The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
70s, baby.
There's hope, then there's reality, and right now the market is pinned between both worlds. Live from a disco groovy Studio 2 here at Bloomberg headquarters in New York, I'm Jerome Boston.
I'm Alex Steele. He's making fun of my shoes. Let's just point that out. All right, let's go to where we are here within the markets. The S&P is seeing a very powerful rally. I'm still going to call it a dead cat bounce potentially, which means an uptrend in a downtrend movement. So can we really trust this rally up 2.5%? Now, the Golden Dragon Index for China might say yes, because that could be a fundamental reason for the rally. As reportedly, the Treasury Secretary said in a closed-door summit, he expects a tariff standoff with China to be resolved soon. Dollar index, relief rally up 0.4%, and gold, a little bit of selling here as we move from those safety trades remain.
Yeah, kind of interesting to hear those comments out of Besson. And you see the S&P 500 rallying largely on the back of that, on the hopes for a trade war reprieve. Besson telling investors in a closed-door meeting down at the IMF meetings in Washington that he expects the U.S. to de-escalate the tariff standoff with China. No details on when, no details on how, but that leaked comment was enough to add fuel to today's rally. Now up 2.5% with the S&P set up now to close higher by 2% for only the third time this year. Any extension of squashing the rally or extending that rally may actually depend a lot on what we learn from Tesla's earnings after the bell. The car company is expected to report stagnant revenue growth and a drop in profit from a year earlier. Now, keep in mind, since it joined the S&P back in late 2020, Tesla has logged only 1 quarter of declining revenue growth, though it has missed analysts' revenue estimates in 5 of the past 6 quarters. So keep an eye on that space, because it is the earnings reports that's coming out in a day where, despite the rally, folks are still positioned defensively, particularly as the IMF sounds the alarm on a global growth slowdown. For the Mag 7, as a group, the ratio of bullish calls to bearish puts right now came close to a 1-to-1 parity. That's the narrowest since late 2023, and less than half of what that ratio, Alex, looked like just about 3 months ago.
Yeah, pretty staggering. And you have the macro overlay, then you have the micro, as Raheem was talking about, and those are the earnings from Tesla. And this chart hypothesizes that the Tesla move is actually going to be quite important for the overall market. This takes a look at the Mag 7 index, which is the orange line, and then the blue line is the S&P, and you can see how they track each other. The more interesting part, though, is the correlation chart, which is right here over 90 days. Now, if you get near 1, it means that there is a 1-for-1 correlation between the Mag 7 and the S&P, and we are very, very, very close to that level. So that means that Tesla, and the correlation I should point out is still pretty high, like 0.94% for Tesla, specifically for the S&P, could have an outsized impact on the Mag 7 and an outsized impact then on the S&P. And that's that micro correlation. That's not a macro move, Romaine, at the end of the day, making that 403 earnings are really, really key.
Full coverage right here on Bloomberg as we kick you off to the closing bell. Lisa Shalett joins us right now, Chief Investment Officer at Morgan Stanley Wealth Management. And Lisa, before we get to the earnings picture, I do just want to get your thoughts on some of the market reactions that we've seen over the last few days and weeks when there is, I guess, some glimmer of hope that there might be a resolution to this trade war. We saw this earlier today with leaked comments from Scott Bessent. I'm still a little confused, though, as to why the market seems to rally as hard as it seems to do, just simply on the idea that the trade war might actually be put to rest.
Yeah, look, I think that the trade war really kicked off a narrative for the market that is very difficult to deal with. And that is a stagflationary scenario, meaning slowing growth with the very near-term potential for higher prices. And that's a scenario, when you think about it, which really crushes corporate profit margins. And so any kind of progress that suggests that we're going to move away from this brink of full-fledged, trade war, full-fledged, tariff rates up, where, folks currently calculate them somewhere between, 17 and 22% with everything that's on the books right now. You're going to see these little relief rallies. Mm-hmm. I think what makes this complicated, as we know, is that this administration has taken a bilateral approach to things, working country by country, product category by product category. And so while I think we can have, some successes for some companies in some product categories, as we've seen with consumer electronics, for example, I think that this is going to be a long, slow road if we're going to go bilateral.
Well, yeah, fair enough. And I am curious then, Lisa, how that sort of plays into your general outlook for global economic conditions, because most people seem to think that there's been a lot of damage already. Maybe it hasn't shown up in the hard data, but even if you do somehow flip the switch tomorrow and all these 75 plus countries have signed trade deals, what's sort of the runway before we actually start to see the benefit?
Yeah, I think that that's really important. Look, I think what we've seen broken are two things. One is trust with geopolitical partners, and the second is fear with economic agents, whether we're talking about consumers, small businesses, or CEOs. And so that soup of uncertainty has already begun to cause some distortions, right? We're starting to see order books slow down. We had seen a pull forward of some demand into March with the retail sales data. And so whenever you start propagating distortions, it can take a while for those distortions to right themselves. So to your point, if we're going to take 90 days to try to get through all of these bilateral negotiations on trade, we could be well into the late summer and fall before we get resolution. And that, importantly, is going to be about the same time frame that we start to get more information about what our budget resolution and our final tax bills actually really look like. And those two things, I think, are going to be the catalyst that could get this market moving again. But our best guess is between here and there, we're going to have a lot more days like Monday and Tuesday back to back, a lot of limbo.
But at the end of the day, we also still have earnings. And that's what I find quite interesting, because you can make the argument that as the trade uncertainty continues, that U.S. exceptionalism theme is always at risk. If earnings hold up, does that sort of say, yup, U.S. exceptionalism is still there?
I don't think investors are so much questioning whether they're going to hold up in Q1, right? I think we know that there was enough momentum and activity coming into this economy for the quarter ended March 30. I think the interesting question that all investors have is, what's your outlook? How much confidence do you as a company have in your outlook? If your outlook doesn't come true, what are your levers to manage profitability, and how quickly are you going to pull a lever to cut capital spending? How quickly are you going to cut costs through employee reductions, et cetera? So I think that's what we're all looking for. And there, I think thus far, the news has been mushy. Where some companies have projected a level of confidence and immunity to the current tariff backdrop, but others are, like some of the airlines, for example, have been somewhat blunt and saying, look, we're navigating multiple scenarios, some of which are recessionary and quite frankly could be ugly.
But it feels like we've re-rated that U.S. exceptionalism trade so much. Is the pain trade to the upside now?
I'm not in that camp. I think we've done some damage, and certainly in the Mag 7 that you led the segment with, we have started to say, yes, maybe, some of the coast is clear with some of those names having sold off as much as 30%. 40% in some cases. But broadly for the market, this is not a market that has discounted the worst case scenario, which would be a multi-quarter recession. And so we think that we could retest those lows again before we get to the fall.
All right, Lisa, I'm just curious, though, too, when we sort of get through this earnings season, this particular quarter's earnings season, and we finally do hear from all of these CEOs and CFOs about their general outlook, do you think you're going to have a more complete picture for what to expect in the couple of quarters ahead?
Not at all. This is that we're in a period where, quote unquote, nobody knows nothing. I mean, again, I have the greatest respect for all of these, stewards of the Fortune 500, the S&P 500 companies who are trying to make it through this. But any of these companies who say they know exactly what's going to happen and that they have high conviction in their earnings trajectory right now, I think are kind of maybe not paying enough attention to how many moving parts there really are.
Lisa Shalett, Chief Investment Officer over at Morgan Stanley Wealth Management, kicking us off to the close here on this Tuesday afternoon. When we come back, a closer look at the health of the consumer, with consumer borrowing stagnating, consumer delinquencies rising, and a lot of focus on, well, how to keep your credit score intact. A conversation with Cynthia Chen of Kikoff a little bit later in the program.
All right, plus a discussion on where the money is going in the funds market and why. Legendary investor John Calamos, Sr., founder and global chief investment officer of Calamos Investments, tells us what he's seeing and how it compares to other periods of uncertainty during his decades-long career.
And we have all eyes right now on Tesla. The shares rallying into the close ahead of a big earnings report. We're going to get quick reaction, raw reaction from Ross Gerber, co-founder, president, and CEO of Gerber Kawasaki, as soon as those numbers cross the wire. Stick with us. This is The Close on Bloomberg.
Richmond's Fed President Thomas Barkin saying today that there's a lot of reasons to be worried about consumer spending. So here's another one for you. How about a weaker credit score? According to a recent FICO report, student loan delinquencies are a main driver in America's average credit score dropping to 715. And Bloomberg Economics says those delinquencies could lead to a meaningful drop in consumer spending. Here with us now with more insight is Cynthia Chen, CEO and co-founder of Kikoff, a fintech company that helps people build credit and improve financial health. Cynthia, I feel like it's worth getting into recent surveys that you guys have about the health of the consumer. What have you guys noticed?
Thank you, Alex, for having me. Yes, we recently conducted a survey on our almost 2 billion users, and we had some very interesting findings. So over 2/3 of our users told us during the survey that they were worried about paying off their daily essentials, including grocery, gas, and utilities. And they are turning more and more to borrowing, including buy now, pay later loans, credit cards, and even payday lending in order to make ends meet. So our data shows that they are definitely feeling the pressure from increasing prices, and they do not have enough financial resources.
And then what's the sort of trickle down of that? So if you need to put like gas and milk on your credit card, then how does that sort of wind up building up so quickly? And then what's the solution that you guys have?
If you keep accumulating balance on your credit cards and you do not pay off the balance by the due date for the payment, then your utilization on the credit card will increase. And you will also be paying revolving interest on those balances. And the average interest rate on credit card balance is north of 20%. So the balance can increase very, very quickly. And it is going to be more and more difficult for consumers to pay down or even pay off that ever increasing balance. And that will also increase the utilization rate, which means that their credit score will go down because credit card utilization rate is one of the key factors in score calculation. And a lower score will make it even harder to borrow.
So also part of that calculation, of course, is just overall debt levels. And I am curious, Cynthia, there's been a lot of talk about the comments out of the White House saying that the student loan forgiveness, which has kind of been in fits and starts for the last few years, that's now over, that effectively not only is the government coming to collect, but if you are delinquent, they will now be reporting that delinquency to the credit bureaus. Are you anticipating that we could see an increase, in the number of folks who are behind, and more importantly, more people who are effectively going to be credit constrained because of that additional debt load?
Yes, absolutely. So about half of our consumers that we serve have student debt in their credit reports. So the collection of student debt payments will definitely make their monthly payment obligations even higher. And any delinquency that they have will definitely impact their credit score. And that's why we introduced an AI debt negotiator to help consumers use an AI agent to directly negotiate down their debt from debt collectors.
Is that going to be useful if your debt collector is effectively the government?
That's a great question. So currently we have covered a number of major debt collectors and credit card lenders. So given that the US government, the Department of Education, is going to restart collection of student loans, we are definitely looking into that as well. We hope we will be able to help millions of consumers on that front.
All right, Cynthia, really great conversation. Cynthia Chen, she's the CEO and co-founder of a company called Kikoff, which, as she was just pointing out, helps effectively to renegotiate some of your debt load here. And as we focus on the consumer, Alex, I thought it was kind of interesting. We actually got some earnings out of Experian, which is, of course, one of the big credit rating companies, Synchrony Financial, which is, of course, one of the big lenders out there, primarily in the auto space. They were actually relatively good. I mean, some of the comments out of both of those companies was that they're not seeing a material deterioration in the ability or the capability of consumers to spend.
Well, yeah. I mean, that's part of the problem, right? Just look at, say, for example, the defense contractors we got today. It was just a huge range. Like some said no effects. We're not listening to any effect. And others say we do see this effect. We just don't know yet. It just depends on how they're going to wind up talking about basically a big fan chart for different issues.
Yeah, absolutely. Here. And you mentioned defense contractors. That was an interesting segue there, Alex.
Thanks. Did you see that? Well, there were so many, and they were all so random in terms of how they presented their outlook.
Yeah, it's kind of interesting, but they're all down, right? It's like, you know, your Northrops, your RTXs, your Lockheed, all moving today. This on the back of earnings. Now, the earnings weren't necessarily bad. You had Lockheed Martin reporting a 1Q sales beat in their earnings today. We're actually going to talk to one of the analysts who covers this company, as well as some of the other defense stocks, to get his take on what exactly is going on with this sector right now. Is it all idiosyncratic, or are they actually going to move together? That conversation coming up after the break, right here on The Close on Bloomberg. All right, let's get a view from the sell side. Top calls. These are the big movers on the back of analyst recommendations. And we start off today with one of our favorites, Macy's. Goldman Sachs actually downgrading the stock to neutral from buy, trimming its price target from $17 to $12. That's the second lowest among analysts covering the stock. Goldman cites slowing GDP growth, tariff risk, and inflation as reasons behind the downgrade. Nevertheless, the share is bucking the trend, up about 1.4% on the day. Next up, Texas Instruments. Barclays downgrading to underweight and setting a street low price target of $125 a share. The analyst says Texas Instruments is getting hit from all angles amid the trade war, especially given its exposure to autos and to China. Those shares slightly higher on the day, though we should point out it's down 27% since its last earnings report. Its next earnings report is tomorrow after the bell. Last up, let's take a look at CoreWeave, the NVIDIA-backed cloud computing infrastructure company that went public last month, getting at least 10 analyst coverage initiations today. 6 of those are buy ratings, including from Jefferies. The analysts there saying we're still at the beginning of the AI build-out, and CoreWeave has been able to scale and host reliably. Jefferies setting a $51 price target, which implies a 30% upside from today's levels, and those are some of our top calls. Another stock we're keeping an eye on is Lockheed Martin, fractionally higher on the day, despite some of its defense industry peers moving to the downside. Lockheed did report net sales for the first quarter that beat estimates and maintain its full-year guidance. Our next guest says, despite the 2025 guide being reiterated, it was still a solid print all around. Richard Safran joins us right now, Managing Director and Senior Analyst for Aerospace and Defense at Seaport Research Partners. He's got a buy rating on Lockheed and a 670 price target. All right, so, I mean, maintaining guidance, I mean, particularly in this environment, I would think would be viewed relatively well. Was there higher expectations? Was there expectations for them to raise that guidance, Richard?
I don't think so. Not too much into the print, but I think the point you're making is that, look, it was a rather disappointing print overall for Northrop. It was a very solid print for Lockheed Martin, but in general, a solid print isn't generally enough to drive investors to the stock. So I think in general, what's happened here is just simply that there was no reason. The reason why you saw the stock Lockheed trade fairly flat today was there was no compelling reason to buy it. There was no upside to 2025 estimates because Lockheed effectively maintained their guide.
I am curious, though, when we talk about sort of the sector basis, you did see decent growth, of course, in the missiles business, a little weakness when it comes to space, and I think some of the other units did okay, like with the helicopter business as well as the aeronautics unit here. These are stocks, when we talk about Lockheed and some of the other defense contractors, these are usually long-term plays because you're dealing with companies dealing with long-term contracts. What is the long-term outlook right now?
I think the long-term outlook is far better than what people expect. So, for example, whenever you want to talk about the long-term outlook, what's the outlook for defense spending? And, initially, the outlook was a little clouded because you had DOGE and the fear of defense cuts. Now that's appeared to have subsided quite a bit. But the long-term outlook, like, for example, right now, if I look at fiscal 26 spending, right, and we take Secretary of Defense Pete Hegseth at his word, right, he's calling for about $1 trillion in defense spending. Well, that's $50 billion above what was initially expected. I think the initial number was, around $751 billion. So I think that the outlook for defense spending right now, if we just based on what the previous administration was saying, was calling for maybe a little bit above 2% growth. I think that right now, you could very easily see mid-single digit growth in the addressable part of defense spending, the part that my companies are essentially tap into.
So, Richard, when we take a look at that, a lot of the spend might come from Europe. Which U.S. defense contractors do we know can benefit from increased defense spend in Europe?
Well, one of those, the two that were reported today were clear beneficiaries. Lockheed Martin, for example, is about 26% international sales. And as Europe starts to rearm, one of the points that I've been making is that Europe has underinvested in defense for quite some period of time. I don't think this is, generally well accepted. Well, I think they're going to need contractors like Lockheed, like Northrop Grumman and their technology in order to bolster their defense. So I think today, clearly, I think that Lockheed Martin is one of the clear beneficiaries from air defense equipment, missiles, weapons, and things like that. All of these things that the Europeans, I think, are going to need.
Richard, we really appreciate it. Thank you very much. Definitely a dramatic day in your space. Richard Safran, Managing Director and Senior Analyst at Seaport Research Partners. I wonder if we learned anything, Romain, though, about how punished Northrop Grumman was based on the numbers. Like, if you deliver, do you soar? And if you just miss, you're just tanking? Like, what is that?
Yeah, I think so, too. And I've sort of wondered, too, like, when you see these kind of knee-jerk reactions in stocks like this that are really long-term plays.
Yeah,
like,
exactly.
Why?
Yes, why? Or is it positioning, or were they also run up into it? I don't know. I really don't know. Also, how do you not have a sense of the tariff issue? How do you buy it if you don't know it? That's the problem. All right, coming up, legendary investor John Calamos, founder, chairman, and global chief investment officer at Calamos. This is Bloomberg.
.30 p.m. here in New York. This is the countdown to the close. I'm Romain Bostic.
And I'm Alex Steele. We're still sitting right on the upside, though, but it's going to be hard for me not to say the word dead cat bounce here.
Yeah, I mean, I don't know what to make of this. I was off yesterday. Apparently, you guys had a little trouble in the markets yesterday.
Sell off, low volume.
Yeah, and it looked like we've recouped all or at least most of those losses today, but should I just prepare for a sell-off on Wednesday?
I mean, that's what it feels like we're headed for. And if you take a look at some of the flows we've seen into like the safe haven areas, it was a great piece out on the Bloomberg terminal. If you look at safer assets like gold, ultra-short treasuries, low volatility stocks, if you put them all together in a basket, you can see the kind of flows we've seen, 18 billion so far just in April.
And even when you look at the factors in the equity market itself, most of the factors that have done well, whether on a pure basis, on a long-short basis, it's low vol, dividend, basically safer stocks.
Well, and this non-safe part, though, treasury, like ultra-short treasury, for example, and also dollar, like they're not participating in that. Joining us now to discuss is John Calamos, the author of the newly released The Sky's the Limit, Lessons in Service, Entrepreneurship, and Achieving the American Dream. He is, of course, also founder, chairman, and global chief investment officer of Calamos Investments. John, it is definitely a pleasure to have you here on set. Thank you for coming in.
Well, thank you. It's great to be here.
So we're going to talk about the book. Want to start with the markets, though, because many say that this period of investing is unprecedented. Historic is thrown around a lot. You've been in this market for, 50 years. Do those words, superlatives, apply to what you see?
Yeah, I've seen that over the years. We see that. A lot has to do with the really fiscal policy going on. And so what's happening with fiscal policy and what's it's causing is a lot of uncertainty. How's it going to work, this type of thing? Quite frankly, I was very positive with what the fiscal policy is. That's very positive for the markets overall. The problem is the uncertainty of the tariffs and that. But we can see, like in the last couple of days, something's working out in India and the market just pops up. So, it's a time for investors not to panic.
So if I don't want to panic, but I want to put my money somewhere where I won't panic, where are those good places right now? And how has that changed kind of over the years?
Well, I think it's still a good place to be in equities. We have alternatives. That's been our trademark for 50-some years now. And what that does is really manage the risk, gives you downside protection. And in this volatile periods, like we're having some downside protection, is makes you feel a bit more comfortable than what's going on.
I am curious, though. I mean, you are well known for effectively shepherding convertible bonds into sort of the zeitgeist of kind of the average everyday investor, the retail investor, if you will, through your mutual funds and later with the ETFs here. When you look at current market conditions, does something like having some increased allocation to convertibles, does that work in your favor in these types of market
conditions? Yes, it does work, and I think it's positive in that sense. We also did come up with some ETFs with downside protection. So those are other ones that kind of mirror the convertible, where you get some of the upside, but you have good downside protection. So in this very volatile periods, that provides a little calming for investors.
Yeah, I am curious as to how much sort of the investing landscape has changed since you cut your teeth back in the 70s, 80s, and 90s, and what we're going through today. I was just going through your book. I mean, there was a great anecdote in there about how you convinced your mother to, I think, give you like $5,000 to buy stocks. And one of the stocks you bought was Texas Instruments, which, by the way, coincidentally reports earnings tomorrow. Oh. And that Texas Instruments, that was kind of a gem of a company back during that phase of sort of the internet boom and technology boom. Not so much now, although it could be again with AI. What do you make of it?
Well, I think there's what we're seeing today and what's happened over the decades now. There's always a change going on. And one of the things we've tried to do in the business and in running the company for over 50 years, almost 50 years now, is really adapting to the changing environment that we find ourselves in. Whether it's global or just themes, technology, AI now, you have to adapt to what's going on in the markets. And one of the main adapters, too, people forget about is the importance of fiscal policy. Fiscal policy, at the end of the game, what I learned in college and studying this, that the market is really the pulse of what's going on in the government. It's really the pulse of what's going on in the government.
So what did you make of that sell-off a couple of weeks ago when it looked like the bond market had really just thrown a tantrum, for lack of a better word?
I think the way I view that was the fiscal policies agenda were good in my estimation, but the uncertainty of the tariffs were really what caused people to really see, gee, what's going on here, what's happening, and that type of thing. And what we're seeing now, if some good language comes out, market pop up.
So let's talk about your book. You've written books before, but this is really a biography, and you're going to have water here if you need it.
Thank you.
So what was it like to write, and what was sort of a takeaway from you? Like, what did you learn as you wrote the book?
Well, actually, my biography, the book writer is Joe Gardner, and he's done a great job with me and talking me through this and getting the biography. So writing the book, really given the history and really how we've had to change over the years. You just can't do the same thing over and over again. You really have to adapt to what's going on. I think in the book I say it's kind of like riding a bike uphill. You got to keep pedaling. If you stop pedaling, you're going the wrong way.
But how hard is it to be that flexible Because do you see the hill before other people do, or are you just really fast at adapting as you're all going down a hill?
Well, you do try to adapt. Obviously, putting the teams together to have good discussions about that is really important as well. You want to really keep thinking about it. It's not always going to be the same way all the time. Technology keeps changing everything, and you really have to adapt to that.
Is this kind of one of those inflection points in our history where a young John Calamos, some guy right now or woman out there who's in their 20s, maybe looking to start their own finance business, does that provide that sort of opening, that opportunity in the same way? Because you came up at a time when the bond market was crazy, inflation was crazy, and we were going through some huge structural economic changes.
Right.
Are we at that point again?
Well, I think we're at inflection points in that sense, but when I look at the fiscal policy, it's thinking longer term, not just what's happening day to day, but longer term. That's very positive. It's really positive to think about what makes the economy grow. Is innovation, less regulation. All those things are very positive for the markets longer term. But the tariffs are really confusing to people, and it's been, we need to sort that out.
Yeah. Well, it may take some time, but of course, in the meantime, it'll be interesting to sit back and watch the ride. And you've had quite a few years and decades to watch the ride, and obviously done great success for yourself and for your company. We really appreciate your time today.
Thank you. My pleasure.
John Calamos, founder, chairman, and global chief investment officer over at Calamos Investments. And of course, he was just talking about those tariffs. They are front and center once again, particularly when it comes to solar stocks. A lot of those names rallying hard on the day. This after the U.S. set new tariffs on solar imports from 4 Southeast Asian countries as high as 3,500%. I didn't even know that was a thing, Alex Steele.
Yeah.
Okay.
Apparently that is.
All right.
But you know what? The solar stocks loved it.
They are. Well, let's see what the man who helps run a utility company thinks about it as well. Calvin Butler joins us here in Studio 2. He's the CEO of Exelon, one of the nation's largest utility companies. Great to have you here. And by the way, I just love the Chicago connection between you and John and me. Alex went to school in Chicago, but she's really
I got 4 years, but I'm a New Yorker.
I love her anyway. I do want to start off, before we kind of get your broad view on things, I do want to ask you about kind of the rally we were seeing in solar stocks, particularly kind of in light of whatever energy transition we're going through. And I'm curious as to what the interplay of dealing with an energy grid that we know needs, to some extent, more capacity or more diversification of capacity, kind of running up against a technology that has, to a certain extent, become a political football.
Yes. First off, let me just say thank you for having me.
Yeah.
And to your point, and I will pick up on what something John just said, stability is key. So as someone who runs a purely regulated transmission and distribution company, I'm looking to provide stability to my customers and my shareholders. And the run up and down is something that you're seeing that is disruptive to the market, but more importantly, it's disruptive to our customers because the affordability piece comes into play. The solar stocks, I think, are significant because they're going to be part of this energy transformation, the solar companies. But how soon we get there and how we implement rooftop solar, community solar for our customers is really what matters.
Yeah, and we should just point out for our viewers, Exelon, of course, you basically control the biggest utility in the Chicago area, as well as utilities in Baltimore, Washington, and a few other places.
Baltimore, Philadelphia, Atlantic City, Delaware, nation's capital, and of course, ComEd in Illinois.
So those are a lot of different regulators you have to deal with at a time when a lot of energy policy right now is being set at the federal level. How do you square that circle?
So, Romaine, that's my gray hair. Then when you talk about, but what I think it comes down to is the foundation of everything we do is about reliable and resilient delivery of energy, point blank. Once you get that under your belt, now you talk to the regulators about what are you trying to do and what are you trying to accomplish within the jurisdictions we serve. A year ago, I would have told you the conversation was all around clean, green, and sustainability. Now it's all about can you deliver the electricity in a way to handle all the growth that is coming into the marketplace. So it's amazing how 1 year the conversation shifts and everyone wants to talk about something different. Clean, it's not even on the agenda right now. It's also about affordability.
So let's take the data center part specifically for that, because ComEd obviously has a lot of exposure to that.
Yes.
So what are those conversations like with the hyperscalers or data centers? Do they come and say, just give me the easiest energy, the cleanest, the cheapest? What's their ask?
Yes. All of the above.
But they still want green. They would still take a green.
They do.
Okay.
As long as it doesn't slow down the process.
Right.
So let's use Illinois as a perfect example. We have over 14 gigawatts of data center load growth that is coming into the state of Illinois. Why? To your point, ComEd is the most reliable utility in the nation, according to our benchmarks. 1. 2, an abundance of clean nuclear energy. But 3, that land that's available to them as well. Mm-hmm. And if you know around Chicago, that northern Illinois, you look around O'Hare, DeKalb, that's an abundance of open land that they're saying we can get in there and get connected sooner rather than later.
So to that point, you guys have planned CapEx about $38 billion over the next 3 years. It's a lot.
It is.
If we get into some kind of economic recession, what's the worry that you won't be able to raise rates and that you'll be regulated like that, which then will affect your ability to pump that kind of CapEx into the system?
What you're nailing down is the number one issue I look at, affordability. How do I bring that new load onto the system in an affordable manner? And what's key about that is that all of our large users, our data centers, large manufacturing, we require a deposit, because I'm always concerned that if we start to build and that load goes away or they don't complete, that cost shifts to you as homeowners. So we require a deposit. And as they continue to build out, we refund that deposit once they get to certain markers. But along the way, that is what we require, because we're protecting the smaller users on that system. And affordability is always the driver on that.
Forgive me if this is a dumb question, but when you talk about data centers, AI, and everything that's fed into that now, it potentially benefits utility companies. At the same time, I saw that rate-based growth is certainly not what it's been in the past. Yeah. Is there an offset, meaning the increased demand that you're potentially getting from data centers and the like? Does that actually help in that capacity?
Ideally, if it's done correctly. And that has been a big debate, that these large users shouldn't shift the cost to the smaller users, and they should all pay their fair share. I mean, think about it. If we're all paying equally and you get more people and the costs are embedded in, it should make that cost go down. But that requires how it's done. We just can't run after the new load and not build it in to make sure we're doing it in an equitable manner.
Have you seen any slowdown from demand from hyperscalers?
No. Matter of fact, I would tell you, I talk about that 14 gigawatts in Illinois. We have another 2 gigawatts across the system, and I have another significant amount of load that we're analyzing today. So we have not seen it slow down. But I would also say, I think they're also forum shopping as to the where, so it may be some double counting, but it is significant.
Just one quick final question. I saw that you're on a panel tomorrow on basically the future of energy security here in the U.S. What's sort of that next step there? Because, I mean, we've created some level of independence, at least in certain pockets of the energy space. What more needs to be done?
Energy security must be the driver of what we do, because if we do not ensure that this grid can handle this new load, the new load would go somewhere else. So as an industry, we have to ensure that we're doing the right things. And I heard John mention about less regulation. We can't build our transmission system fast enough to manage this load. And we need the regulation to step away, allowing us to do what we do best. And I think that's build things.
Well, it's been a pleasure. Thank you for coming in. We definitely want to keep up the relationship and catch up with you later. Calvin Butler, CEO of Exelon, thank you very much. All right, we are about 15 minutes away from the closing bell right here in the U.S. Jerome Schneider, Managing Director and Head of Short-Term Portfolio Management and Funding with Pimco, will be joining us. Take a quick check in here on the markets. The S&P is up 2.3%. Volume, though, still weak. So do we really count these last 2 days, Romaine?
I don't.
You don't. That's because you weren't here yesterday. So it's only been a few hours for him. That's the probable why here. And the dollar seeing a bit of a relief rally. This is Bloomberg.
We're in a period where, quote unquote, nobody knows nothing. Any of these companies who say they know exactly what's going to happen and that they have high conviction in their earnings trajectory right now, I think are kind of maybe not paying enough attention to how many moving parts there really are.
Lisa Shalett over at Morgan Stanley Wealth Management, kicking us off to the close just about 50 minutes ago, Alex. A pretty strong rally here that has effectively erased all of the losses from yesterday. I guess the question is, does this stick until tomorrow?
I know. I just look at the volume, right? Volume's really light, so you have to question that as well. But some of this is driven by what happened. The headline that was reported by Bloomberg that Scott Bessent reportedly told investors behind closed doors that there could be a trade deal with China, that is coming along. It's coming on that way, and that's why you saw the likes of Apple, say, moving higher, as well as the semi index as well. And you really saw the high of the session during that.
Yeah, absolutely. Here, that, of course, put a pin under the market. Maybe after the bell, we get another pin. Tesla set to report earnings after the bell. Some other earnings as well, including from Enphase, Steel Dynamics, as well as Capital One. Jerome Schneider joins us right now in Studio 2. He's Managing Director and Head of Short-Term Portfolio Management and Funding with Pimco. All right, I got a lot of questions for you because it's been a month, to say the least here. A lot of volatility. I know volume, at least this week, is a little bit lighter, but the volatility is still there, at least on a realized basis. Pick an asset class, it's there. Is that volatility evidence that something's broken?
No, it isn't. I think what we're witnessing is the repricing of liquidity, actually, as well as the expectation of what the outcomes could potentially be on the tariffs, which is a longer term discussion in terms of growth, in terms of inflation. From a functional perspective, let's start at the main set. When we come into work at 3:45 in the morning on the West Coast, we're focused on liquidity markets. How is the market functioning? There is not a systemic risk in that sense. We're not seeing breakage in the repo markets. Banks are well capitalized. Global liquidity in FX markets is there. So the basic tenets of concerns that we had in the global financial crisis are not imminent in this current context. What we don't have is the clarity on the destination of growth, where the clarity on the destination of how companies can adapt to this current landscape. So as a result, we're seeing premiums for moving capital from one market to the next increase. Execution costs are increasing in equities and bonds, et cetera. And that's simple function of a healthy market functioning. And so the cause for concern is that people haven't really rationalized that in the current mindset and are just simply saying there's a lot of volatility, which is another way of saying the cost of bid offer of transacting in any markets, including treasuries, is higher than it was a month ago.
All right, I'm going to set aside the fact that you just very casually said that you are in the office at 3:45 a.m. I know for you West Coast folks that's normal, but still, it was a little jarring to hear that. But to your point, though, and not to be pedantic, though, but when you start to see that issue with price discovery and the issue with costs of transactions going up, is that not a precursor to maybe something breaking?
Well, I think what you have is a lot of trades that were highly levered going through a very narrow door. You can look at very small markets, swap spreads, basis trades, things like that. They get a lot of press. But the reality is that risk is still moving around the ecosystem. It might be more costly to do so, but that's simple fact, which is obviously creating a guttural reaction for many investors. Many investors moving to cash, many investors moving out of risk-seeking assets because of this, because the outlook has changed. So until this gets reconciled, coupled with a Federal Reserve, which is clearly in the tension between growth and inflation outlooks, we have to resolve that outlook. So that creates a bit of trepidation in terms of how much risk you actually want to take in this market. So it's not unwise for investors to sort of take a more cautious view and perhaps de-risk in these current environments.
I just want to ask you about a headline that recently crossed here. So apparently Wall Street banks are now stuck with about $1.1 billion of leverage loan supporting HIG Capital's buyout of Converge Technology Solutions. We've seen this movie before. We've seen it in times of stress, 2020, we got 2015, like that in and of itself is nothing new. When does stuff like that start to build a little bit?
Well, when you need to rationalize a clearing level. The starting place is that regulatory frameworks are well intact in terms of how they're going to deal with bank balance sheets and commercial bank balance sheets. Second thing is when you have the market that's functioning for a clearing level of risk, then you're going to obviously trying to realize that. Creating that market, whether it's for agency mortgages or treasuries or even private corporate loans, it's a bit of a fact-finding mission at the most. And so that's a price discovery. But again, that's part of market transparency. Right. And that's exactly what they're trying to do, is find the clearing level for appropriateness in this market.
That's a good way to look at it, right? It's like we have to find the clearing level, and if we don't find it yet, we're gonna be sort of throwing some darts at a board to see what fits. In the meantime, what do I do? Right.
So you basically think about the markets as a liquidity-driven instrument, meaning as an investor, you want to be finding opportunities where you can put your cash or liquidity work and earn above market premiums. At the same time, don't be fooled into what we would call a liquidity mirage, meaning assume that all markets are liquid at zero cost. That's definitively changed over the past few weeks, where even those liquid markets have a cost to them. At the same time, go to the other side of the equation, those investments which have been pretty much seeking to obtain liquidity premiums, additional returns because you're more illiquid, that could be effectively what is formerly thought of as a liquidity oasis. You're finding this well of water in the desert. Well, the reality is that may not necessarily be there. So be very clear about how you're managing your liquidity at this point in time. You don't have to take a lot of risk to earn 5 to 6% returns. And most importantly, in this above market inflation, inflationary environment, focus on what your purchasing power is, which is a very basic concept for investors, corporations, endowments, but that dollar today is worth a lot less tomorrow. So how you manage it, how you put it to work has to be really thought about.
I am curious, though, but on that point, too, about purchasing power and inflation, like we've seen this huge uptick in inflation expectations, which are to a certain extent, pretty divorced from actual reality. Mm-hmm. Now, maybe that becomes a reality, but what do you make of that huge gap when you have consumers basically saying we expect 5, 6, 7% inflation, and yet you're seeing hard data that's nowhere near that?
Well, we at Pimco, we think that our core expectation for inflation is at 4%, slightly above as we end 2025. So definitively higher and in the uncomfortable range for the Federal Reserve. So from that perspective, the Fed is probably going to have to take that into a large ingredient mix in terms of its output for the next few meetings. That being said, it's above market. And so you could argue whether it's 4, 5, 6, or 7%, it's still at the uncomfortable phase. And people haven't been really conditioned to inflation and the effects of inflation for more than 3 decades. Now it's time to start thinking about it and what it does to the real life and thinking about it in terms of portfolio construction as well. And that's really what we're saying at Pimco is focus on the building up of the foundation, your liquidity, how you're actively managing your liquidity, and then find the opportunities as they reveal themselves as we get more certainty coming out of this focus on tariffs.
All right, Jerome, always a great conversation. And you move out here to the East Coast. You won't have to get up as early.
You can sleep later.
Jerome Schneider, Managing Director and Head of Short-Term Portfolio Management and Funding over at Pimco, helping us count you down to the closing bells. Just about 2.5 minutes to go. Alex, stocks holding their gains, at least right now, into the close.
Yeah, sure. But, we get Tesla.
You're hard to impress, aren't you?
It is. We hold the game.
Can you hold your foot up and show everyone your shoes?
No, you have to go back and rewatch the top of the show. But, it's the whole thing could be changing in about 5 minutes' time when we get Tesla. Because that correlation, it could really move the Mag 7. That could really move the S&P. Absolutely.
Options markets pricing an up-down move of about 9% on that stock. A full breakdown of the broader market starts now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele taking you through that closing bell. A global simulcast. It starts right now. Carol Masser and Tim Stenovic in the radio booth. Scarlet Fu on assignment today as we welcome our audiences across all of our Bloomberg platforms, radio, television, and of course our partnership with YouTube. A pretty decent rally, Carol Masser, 2.5% on the S&P 500. Well, is that going to be 2.5% tomorrow as well?
I don't know. Time will tell. Let's see if Tesla has anything to do with it. Maybe we could get some indications from Alex's shoes. Is there anything that we can get out of that?
Nothing.
They're
you can
groovy.
learn nothing. These look like they're from the 70s. So I don't know what that tells us about inflation.
Wait a minute. I don't know. Yeah. Are they platforms?
Yes, they're
are.
platform. They're like 5-inch platforms.
Like how skirts, like minis, maxis, give indication for the economy?
Is this what we're talking about?
I don't know if deals are going to be that. But you know what's going to happen?
Yeah.
We're going to get Tesla in 4 minutes.
All right. We'll get back to what we need
But
to do.
before that, I think we should talk about why stocks are rallying today. The crucial moment of the day was just around noon when our own Bloomberg News team reported Treasury Secretary Scott Bessent's comments from this closed-door program down in Washington. It just shows how eager people are to see progress on the trade deal or a trade deal. We don't have any details on it. We have no idea of a timeline here. We don't know anything about it, but investors are optimistic.
I mean, yes, but ... We also saw futures higher before any of that happened in the morning because we had that sell-off yesterday. So it's hard to take direction from the headlines. But to your point, when volume is thin, you're going to have whippy moves.
And I would just point out, too, and we also had some decent earnings today that I think also maybe gave some folks a little bit of life, whether it was Pulte, whether it was GE, whether it was Synchrony, even Verizon and Danaher reporting some relatively decent earnings here. And 3M as well, one of your favorites, up 3M. About 8% here on the day as we get the closing bells in New York. And as we await those earnings out of Tesla, a Dow Jones Industrial Average higher by 1,000 points or 2.7%. The S&P higher by 130 points or 2.5%. The NASDAQ adding about 2.7% here on the day. And the Russell 2000, the small caps, up on the day, 2.71%.
Wow, nice big move up to the upside there. Let's take a look at the S&P 500. Guys, almost every name higher in today's session as we settle in. Right now I'm looking, Alex, at 494 names actually gaining in the S&P 500 today, 9 to the downside.
Pesto pie, guys. It's all green. Let's just leave it right there. Green across the screen. You've got consumer staples, industrials, healthcare, and real estate. Those are the underperformers, and they're still up anywhere between 1.5% to 2%, outperforming financials, discretionary, and communication services. Guys.
All right, guys. Let's get to some of the individual gainers as we wait a drop of earnings, including Tesla. And I'm going to start with Tesla, up as much as 6.7% ahead of earnings today, finishing with a 4.6% gain. It was a top gainer in the NASDAQ 100. Dana Hull actually putting out that the treasurers of 8 U.S. states have written an open letter to Tesla's board of directors expressing concern about the company's direction and Elon's level of attention to its challenges. So we'll see if we get maybe any kind of upbeat news that maybe puts some of them, their concerns at rest, but we'll see. For solar.
And I just want to add, too, we're actually going to talk to one of the signatories on that letter, the California State Controller, in the 4 p.m. hour right here on Bloomberg.
Pretty cool stuff. So that'll be interesting. In the meantime, First Solar, we did see solar stocks rise after the U.S. set new duties as high as over 3,500% on solar imports from 4 Southeast Asian countries. So the whole sector really popping in today's session. You have First Solar up about 10.5%. And Equifax, you mentioned earnings. Number one gainer in the S&P 500. The Consumer Credit Agency did report adjusted earnings per share for the first quarter that beat the average analyst estimate. They kept its 2025 guidance even with uncertainty in macro and markets outlook, and they boosted their quarterly dividend and announced a $3 billion buyback. So again, that stock, Equifax, up about 14% today.
Okay, you had the gainers, I have the decliners. I want to start with Northrop Grumman. It closed down 13%. This is its steepest one-day drop going back to 2008. The company reported a 47% decline in first quarter profit. It missed analysts' expectations. It cut its earnings forecast for the year due to increased costs for its B-21 stealth bomber program, a $477 million addition to its pre-tax charge on that B-21 program, and slashed its outlook for operating income by up to $600 million for this year. Also, Kimberly-Clark getting hit with tariffs, as a result of tariffs, I should say, down 1.5%. The company lowered its profit expectations for the year due to uncertainty from the global trade war's impact on its costs. The company estimates tariffs are going to add about $300 million of incremental costs, which with plans to offset these costs over time by finding savings within the supply chain. And finally, Halliburton shares falling today by 5.6%. The company warned investors that tariffs will impact its business units. It expects a 2 to 3 cent per share impact on the second quarter. Shares fell as a result. 60% of the tariffs impact affecting its completions and production unit, which houses its fracking business, Alex.
All right, just real quick, want to hit on yields here. So you have the front end selling off a little bit, a little buying in the back end, but that buying in the back end was no match for that dramatic selling that we've seen in the last few weeks. We did a 2-year auction, so we get a 5 later on this week and a 7. The 2-year auction was fine. I mean, nothing right home about a little weak bid to cover ratio, but you got lower yield, so a little bit less incentive on that, guys.
Yeah, as we await the earnings out of Tesla and a few other names, I want to bring your attention to Oklo. This is the nuclear power company that helps to build nuclear fission reactors, down about 11% right now. We've now learned that Sam Altman, of course, this is the co-founder of OpenAI, he was the chairman of the board of that company. We're now learning that he has stepped down from that role. Not quite sure for the reasons, though. We should point out he's definitely a busy guy with his other projects, but nevertheless, Sam Altman, who had been the chairman of Oklo, stepping down from that role. Something to keep an eye on there as the shares move lower here in the after-hours trade.
Yeah, Dow Jones, though, saying Oklo to continue working with Altman to explore strategic partnerships with leading AI companies, including potentially with them. So there's a little bit more to it. Hey, some earnings. Intuitive Surgical just crossing the Bloomberg terminal, folks, and the company coming out first quarter revenue slightly better than what the street was expecting. $2.25 billion. Estimate was for $2.19 billion. First quarter adjusted EPS also coming in 9 cents better than what the street was expecting, coming in at $1.81 a share. And then some outlook sees fiscal year gross profit margin 65 to 66.5%. Had seen 67 to 68%. We are seeing the stock taking a bit of a hit, down about 5.8% here. So that has to do, one would assume, with that outlook.
Okay, I had one of those surgeries with one of those intuitive robots.
The Da Vinci.
Oh, yeah, me too.
Yeah, it was great. And by the way,
it was great because you were awake for it.
Well, no, I was. No,
that's what I'm saying.
Like, I had a real thing. And I should point out, my doctor was a pioneer in that. Not to brag or anything, but he was a pioneer
Okay,
the Da Vinci.
that's some good flexing there.
Good to
My
know.
valiant fight.
Nice job.
Hey, while we await Tesla, we're hearing from some other companies now. Capital One with the results. First quarter adjusted earnings per share beat estimates. First quarter net interest margin coming in just shy of estimates at 6.9%. Capital One first quarter adjusted EPS coming at $4.06, beating estimates of 3.6%. Shares right now down by about 0.9%.
Tesla earnings crossing the wire. Adjusted EPS, a big miss, 27 cents a share. The street was looking for 43 cents a share. Revenue in the most recent quarter, $19.34 billion. That's a big miss. The street was looking for $21.37 billion. The company also saying that the tariff landscape is going to have a larger impact on its energy unit. It's also saying that it's difficult to measure the impacts right now of global trade policy, and also saying that its rate of growth will depend on a variety of factors and that it will have to revisit its 2025 guidance when they give their second quarter earnings update in about 3 months' time, guys. You see the shares only fractionally lower, of course, down about 51% since that all-time high back in mid-December.
Well, here's a fun sentence from Tesla, right? Sufficient liquidity to fund our product ramp up. You never like to get, you're glad that they have sufficient liquidity, but to sort of preempt it, to say that statement always gives you a little bit of angst as to why. And that operating income for the first quarter coming in $399 million estimate was for over $1 billion.
You know, I'm going through the release here. You guys mentioned the automotive and energy markets continue to uncertainty there, but the note saying this dynamic, along with changing political sentiment, could have meaningful impact on demand for our products in the near term. We remain committed to expanding our business model to include delivering autonomous robots across multiple form factors and use cases, powered by our real-world AI expertise, to our customers for use in our factories as we navigate these headwinds. I know you guys are going to be speaking to Ross Gerber soon. He wants to hear more about cars and less about the autonomous robots that the company is working on.
I'm just going to say, and also in that release, the financial summary, I mean, there's a lot of like declines year over year. Total revenue decreased 9% year over year, $19.3 billion. And they talk about the items, decline in vehicle deliveries. And they talk about in part due to that Model Y update. They talk about reduced vehicle average selling price due to mix and sales incentives. They talk about currency, higher regulatory credit revenue. I mean, stock, I don't know. It's like investors trying to make sense of it.
Yeah, and this gets to this idea, sort of what's in the pipeline as well. I mean, one, I just want to point out to Alex's point too. I mean, we're talking about a company, when we talk about liquidity, remember, this almost feels like deja vu. Remember, a few years ago, that was all the talk. Every quarter was how much cash is it generating, how much is it burning. We're seeing that drop in free cash flow, at least in the most recent quarter. And of course, now that they would put out a statement about that, a fiduciary duty to do so, I think you have to at least be mindful of that if you are an investor.
All right, lots of questions, I'm going to guess, on that analyst call. So looking forward to seeing what more color we get around their business. All right, guys, that's a wrap. Our cross-platform coverage, including Tesla earnings on radio, TV, YouTube, Bloomberg Originals. We know we're all going to continue talking about Tesla. All right, that's a wrap. We'll see you again, same time, same place tomorrow.
And we continue our coverage right here on Bloomberg Television. Tesla shares all over the map here in after hours trade, only down fractionally at the moment for its first quarter numbers on an EPS basis and a revenue basis. Two big misses, 27 cents a share on adjusted EPS. On the top line, $19.34 billion in revenue. Both of those were a miss, but more importantly, the company basically making it clear that whatever guidance it's going to provide for 2025, you're not going to get a more accurate picture until it gets to that Q2 update. The company saying that the tariff landscape going to have a larger impact on some of its operations, particularly in energy, and that right now it's just kind of difficult to figure out what the future holds. Seth Goldstein is equity strategist at Morningstar Research Services, and he joins us right now. Seth, on the surface, these comments aren't totally surprising. We've kind of known the bind that Tesla has been in, both because of economic conditions, but also, of course, let's just say some of the political conditions as well. What was your first take when you saw these numbers?
Well, you know, we knew with deliveries being down 13% year over year that the financial results would likely follow that and give us more detail. Obviously, for automakers, when you have lower production and lower volumes, you're going to see a bigger profit hit as well. So a lot of the numbers were not surprising. What I was really focused on is what's the outlook. And what's the outlook for more affordable vehicles? We saw a media report earlier this weekend, that said the affordable vehicle would be delayed until either later this year or even early 2026. in the deck I just read, Tesla's saying they're still on track to begin production by the first half of 2025 for the more affordable vehicle. So I'd like to hear more on the earnings call later tonight, what management plans to do if there's an updated timeline for when those deliveries will begin. I also wanted to see if they were going to be still on track with the launch of the autonomous vehicle, the testing they're going to do in Austin, Texas, still on track for that. So, despite a lot of the tariff-related near-term uncertainty, I think Tesla's long-term growth strategy remains on track, and that was reassuring to see.
Well, what does that, though, look like? So, let's first take the autonomous vehicle for one. They kind of say that they're still on pace for what they call volume production starting in 2026. So that's still less than basically a year away at most. Do you have confidence that they can meet that target?
I'm forecasting they're going to be launching their autonomous vehicle robotaxi service by 2028. I think that when you look at the full self-driving software as measured by the miles per intervention, meaning when the software system stops working and a human has to take over, they're still well below the 10,000 miles per disengagement threshold that we need to see to offer a robotaxi service. So I want to hear from management tonight where they're at with that progress. But I don't think the FSD software is going to be there by 2026. So I think even if they can begin producing the Cybercab next year, I wouldn't expect to see it out on the streets for another couple years after that, which is how I get to my 2028 forecast.
And so with regards to the other vehicles that may or may not be coming, because there's been a lot of discussion, Seth, about this idea that some of its models now, at least in terms of design, are a little stale, for lack of a better word. They've been out there for a while. Maybe that's a more better way of putting it. So people are looking for whether there's going to be a refresh or something completely new and something ideally that's not the Cybertruck.
That's right. And we saw the new Model Y, I think, was a big drag on first quarter deliveries because it wasn't out yet in many of Tesla's key markets. It wasn't really out till March in the U.S., only in a select number of European countries, and just starting to get out in March in China as well. So I think that really dragged down the first quarter deliveries. But now that the new Model Y is being produced and being sold in the three key markets for Tesla, I think we'll see in Q2 if, how much of the deliveries decline was consumers waiting for a new model, how much are consumers waiting and not buying a Model Y for the more affordable model, or is there political risk, and especially in the U.S. and Europe associated with Tesla, that's causing many consumers to seek alternative vehicles?
Well, just looking at this deck, Seth, they include a great chart in here that kind of shows you that political risk here. 3 lines, the U.S., Europe, and China, in terms of its market share of Tesla vehicles by region. All of them have basically flatlined, but none more so than what we're seeing in Europe and China right now.
That's right. And I think a lot of what we saw in China could be attributed to waiting for the full self-driving to be approved. We saw week over week orders immediately started to improve once they received that approval to launch the full self-driving software, because for many consumers in China today, they need a car to have the autonomous driving, the level 2 software. And so if Tesla did not have that approval, many consumers were holding off on Tesla vehicles. So we'll have to see how that market progresses in the second quarter and beyond. For Europe, there's still a big question to me whether consumers are waiting for the new Model Y or whether Elon Musk, campaigning in the recent German elections turned some consumers away. And I think that'll be answered throughout the year, especially in Q2 as well, now that the new Model Y is launched.
All right, Seth, we'll let you get to work here. I know you got a busy night ahead of you. Seth Goldstein, equity strategist at Morningstar Research Services, instant analysis of those numbers out of Tesla. The shares, though, holding up here in the after hours, trade up fractionally on the day. That stock, of course, had been reeling for quite some time. In fact, it was down 51% from that all-time high set back in December. And our next guest says this is a difficult time to be a Tesla shareholder and even a tougher time to be Tesla itself. Ross Gerber joins us right now. He's president and CEO at Gerber Kawasaki Wealth and Investment Management. So, Ross, you knew the numbers weren't going to be great. Was this really disappointing, what we saw today, or did you get some encouragement?
I didn't get as much encouragement as your other guests, but it was certainly in line with what we expected, with automotive revenues down 20%. Really, energy storage is the really important positive moment for the company, because, boy, did that save their earnings. So they've got some things working for them in the energy storage business, but the car business seems to have plateaued and is on its way down now. And And so this is a troubling report. All the metrics are down, and I think the bigger question is, what will they do to reverse that? Because it's not about launching new models. It's not about anything other than improving the optics around the company, because people don't want the products because of the behavior of Elon Musk. And so until you can convince people to want Teslas, I don't see where it goes from here.
Well, I mean, I do want to talk a little bit more about that, but just to your point about the energy storage side, I mean, and I know it's still a relatively small part of the business. Do you see long-term possibilities for that to become a bigger part of the business, a bigger contributor to profitability?
Yeah, absolutely. And in fact, it's the only part of the business that consumers don't have to purchase. It's purchased by utilities. So you're not going to have the same political, negativity surrounding utilities purchases, which it's really beneficial for, especially for clean energy utilities, to purchase battery systems from Tesla. We love this part of the business. We have no complaints about the core business of selling EVs with full self-driving, energy storage and charging. And that's the business Tesla should be focused on, because I think what they're going to learn about cybercabs is it's a crappy business to be in, highly competitive, very difficult, and they've got to get their software and hardware to work, which they still haven't done. So in hindsight, they might really miss just selling EVs to people, and that's still a growing market.
Yeah, and I was just taking a look at some of those numbers on the energy side. Definitely, like I said, one of the strongest, not only just in terms of revenue, but obviously an expansion in margins, while margins elsewhere seem to be contracting. All right, so
exactly.
So when we get to this conference call in, I think, about an hour and 15 minutes time, 5:30 p.m. East Coast time, what do you think that Musk, and for that matter, if he lets the other folks speak, what they can articulate about a long-term vision for this company? Because as you know, Ross, the long-term vision for this company has, for one reason or another, been really just thrown off kilter. Maybe it's because Musk is involved in some other things that we've heard about, or maybe it is just there's just more competition right now for EVs.
There is more competition, but Tesla is still much better. And what all of us in the investment community was thinking, let's say 2-3 years ago, was Tesla was on track to building 20 million cars a year. That was the sort of the plan. Let's get to 10 million. Let's get to 20 million vehicles a year. It was about solving climate and selling EVs and battery storage. Now it's an AI robotics story. And Elon's going to work very hard in the conference call to get you not to pay attention to EVs, that EVs aren't the story anymore. And it's all about robotics and self-driving cars. And so really what he wants you to think about is this future that he sees, where we're all going to just have like self-driving cars drive us around and robots doing all of our work. And what I challenge, listeners or viewers to ask themselves is, how long do you think it'll be until that vision actually exists? Because I think that's how long it's going to be before Tesla makes money again. Because at this current rate, they're basically a little above break even. And, quite frankly, with revenues continuing to go down in automotive, I just don't see where this goes. So how long will it be till you have a robot in your house and everybody's using self-driving cars? And I think it's going to be some time, and that's the problem.
There's also a credibility question, and I'll be a little sensitive in asking this question, but you're talking about a man who controls these companies, who, as you know, has been derided for a lot of political reasons, a lot of them self-inflicted by his own comments and behavior. If people don't trust him enough right now to continue buying cars, buying Teslas at the rate that he had gotten used to, why should we believe that there would be any sort of widespread adoption of some of his other products, like in the robotics and energy space?
Right. And I think that's a great way to look at it. It's like, how many lies or false promises or whatever you want to call it Elon can make over the years before you get to a point of total skepticism. I tend to look at both sides, being an optimist by nature, being a long-term Tesla shareholder who's benefited greatly from the success of Tesla. I want to believe in this future, but when I get in my Cybertruck and I turn on full self-driving, it doesn't drive me very far before I have to intervene. And it kind of drives like crap, to be honest. And now there's Waymos everywhere in my neighborhood, and the Waymos drive way better than full self-driving. I'm sorry, Elon, your software sucks compared to Waymo. So when you want to wake up and smell the coffee, that would be great, because I think the vision is possible, the vision he's articulating. I just don't think Tesla's on track on doing that anytime soon. So that's really the issue, is if Elon wants to get off his butt and go work at Tesla and start building this software, that would be the best thing that could happen to Tesla. And that's what I expect him to say in the conference call, that he's ending his his Doge time any day, and he'll be back to fixing all the problems soon. And that's the only thing that'll get the stock going. And he knows that. So that's what he's probably going to say in the conference call.
Well, and a lot of investors have been sort of hoping for that. I am curious just about your own stake in the company. You obviously were a very early adopter, both as a user and as an investor in Tesla. And I know you've had some reservations over the last few months for a variety of reasons. Ross, do you think there is a plausible scenario where you would materially increase your investment in Tesla?
Yeah, once again, I still think Tesla makes the best products. So the scenario would be where I can't imagine a scenario where Elon stops saying divisive things. So I'm not even going to bring that up. But maybe they get a new CEO and Elon becomes chief product officer and somebody who can visibly take over the sort of reins of the image of the company and move it away from Elon and move it back to Tesla. They would need to do a massive marketing campaign to try to rebuild brand value and recognition. They would have to really make an amends to many of the consumers and refocus itself as an environmentally friendly and climate friendly company, because that's what motivated the huge legions of Tesla buyers to refer their friends and family, was the fact that we were solving climate change, which is a much more important goal than any of Elon's goals, including robotics. In fact, there's really no reason to worry about robotics when climate change is on verge of wiping out human existence in the next 30 to 50 years. So we really should be focusing on what Tesla does best, which is solve climate. We can certainly work on robotics and cybercabs. I'm not against that. But Tesla's success will always be about being a climate-focused company. And I think that's what they need to do to rebuild their brand and potentially be a great investment again.
So final question here, and this is also about Musk personally. There was a lot of people that when he helped Trump get elected, when he clearly had a seat at the table in the White House, there was this idea that this was obviously going to benefit not just him personally, but was going to benefit Tesla and, for that matter, his other companies as well. Do you think that relationship, whatever that relationship is with the president, will have a net positive impact on his businesses?
No, I don't, and I never thought it would. And if you look at Trump's history with all the other people he's been associated with and the impact it's had on their businesses, there's a long history of bankruptcies around Trump. Trump has never actually made anybody successful or any company successful. And so when you look at the track record of Elon Musk versus Donald Trump, it's like laughable. And that's why, Trump likes Elon, because Elon's like 100 times smarter than him. But I think the reality for Elon is that the Trump people don't want him anymore because he just causes problems for everybody. And so, it's just a matter of time till Elon goes back to being Elon. And I don't know what that is, but I still think it'll be divisive. And I don't think it helps Tesla at all. And I don't think Trump cares about Tesla and wants to help Tesla at all either. And that's kind of why I'm upset about the whole thing.
All right, Ross. Well, we always appreciate your candor. Going to leave it there. Ross Gerber, President and CEO of Gerber Kawasaki Wealth and Investment Management, and, of course, an early investor in Tesla shares. Meanwhile, of course, as we keep an eye on those numbers out of Tesla, you'd be remiss in not really taking a look here at its market share on a region-by-region basis. The company has really been battling it out in the EV space, and nowhere is the competition stiffer than in China, particularly coming out of it, the main rival over there, BYD. Over the past 3 months alone, Tesla shares have plummeted, while BYD's have skyrocketed. Ed Ludlow covers both companies, really the EV space for us here at Bloomberg. He is a co-host of Bloomberg Technology. And Ed, I was just looking at that chart they had in their deck, kind of showing the flat line in market share, not only in China, but you also saw it in Europe and to a much smaller extent in the U.S. But let's focus on China here, because the scuttlebutt seems to be that they're losing market share not because people hate Elon or they hate Teslas. It's just that BYD and some of these other Chinese-based companies are just making better cars.
Right. And it's funny, the headline is like they weren't able to give guidance and they'll revisit in the second quarter for volumes. But in their discussion of China and Asia Pacific specifically, they gave us much more information. So in the quarter, the refreshed Model Y launched out of Shanghai. It experienced a record sales day, according to Tesla. They talk about the idea that it is the most competitive EV market, but they think that that has a long-term net positive impact to their sales, because they say, without citing specific competitors, that if there are more models on offer and it is a more competitive market, adoption overall will be much more accelerated than it is perhaps here in the United States. clearly when it comes to short-term profitability, they took a hit, but they are talking up about how localized each supply chain is in each region. And in China specifically, this cost structure. So we always look in the delivery figures each quarter, the mix of vehicles that come out of that Shanghai plant, a higher mix of those vehicles has higher sort of margin profile and things like that. They're also talking about that in the deck in the context of energy, right? They are competing not just with the OEMs on the cars, but other specific battery makers and peers that have energy storage technology. And when it comes to energy storage, they're basically saying everything that we make out of Shanghai in terms of energy markets for Asia Pacific is localized to Shanghai. That gives us an advantage at a time where quite clearly, verbatim, there is uncertainty due to rapidly evolving trade policy. But it will be interesting to see if politics was an issue here. They acknowledge a changing political landscape. We know the story here in the US. What about in China, where the consumer does champion domestic names when there is a political, let's say, scenario ongoing?
Ed Ludlow, the co-host of Bloomberg Technology, a closer look here at those earnings out of Tesla, particularly through the lens of the competition in China. As our next guest kind of weighs in on the whole global EV landscapes and talks about the idea that the U.S. risks falling behind if it doesn't accelerate domestic investment. Remember, Tesla was that investment for a while, not necessarily the focal point anymore. Karim Bousta is co-founder at DVX Ventures, and he was also a former executive at Tesla, as well as some other companies, including GE and Symantec. Karim, great to have you here on the program. I do want to start off with your time at Tesla, because, you were basically the guy who really kind of helped to build, or at least to scale up, the customer and service business there. And I do wonder, when we talk about the whole ethos of Tesla, it wasn't just about buying a car, per se. You were really buying just into a whole ecosystem, and more importantly, you were buying into, I guess, for lack of a better word, a whole community. And I am curious as to whether that's been lost in your view.
Yeah, you're totally correct. That's one of the things that attracted a lot of people to Tesla, both as employees and customers, and also way beyond customers, fans and supporters of the company. If you go back to the original mission of the company, it was to accelerate the transition to sustainable energy. And for many years, Tesla has been at the forefront, has been the leader of that transition. And in a way, when you look at the situation today, outside the results that we're all commenting of today of Tesla's first quarter, we have to realize that the company has achieved that goal. So the EV transition is happening, and the best testament to that is that there is competition. There's a lot of great products out there. There's a lot of great companies that are producing products that customers love. So I think what you're referring to, this mission that the company had, this approach to doing business to transform the automotive industry, has largely been realized and achieved. And now the only thing is we're not relying only on Tesla to make this thing happen. Yeah. And in fact, Tesla is actually on many fronts is actually running behind compared to competition. Yeah,
and I mean, look, and it's good that I think what Tesla has done over the years did open the door for a lot of other companies, not just in the car space, but just overall in the renewable, sustainable energy space, to realize that there was a path to creating a profitable business out of it. At the same time, if you're an investor in Tesla, you want them to keep their sort of market lead, their market dominance, if you will. And I have to just ask you this bluntly, Karim, is Elon Musk really the guy that can take them to whatever the next phase of Tesla will be?
You look at where the company is at, we really have to realize that it's not just about the numbers that were announced, that were released today. There's a number of problems and challenges that the company is dealing with. These problems are not new, and they're not going to be solved overnight. It's essentially two things. One is around the product lineup, so coming up with the next generation of vehicles. If you recall, the Model 3 and the Model Y that have been the platform that has driven a lot of Tesla's growth, they were announced in 2016, launched in 2017. So that's many years ago. So first challenge is to come up with the next generation product lineup. With regards to, so how do you do that? How do you invest? Do you have the focus and the energy to do that? These are all questions that I think the company is is going to be able to answer in the coming weeks as they deal and unveil the plans. Then the other challenge is about the strategic shift towards robotaxi, AI, and robots. Where the vision outlined by Elon has been very clear, is very compelling, but then it's all about the execution and the ability to make this happen.
Where is it?
Well, there's a lot of competitors that are actually ahead.
Well, that's what I'm curious about. Where do they stand in that? Because, I mean, we had a previous guest on just a while ago talking about Waymo, and we've seen a few other companies, not named Tesla, seem to make pretty big strides in this space. And I'm not clear when we would expect to see an autonomous vehicle approved to be on the road that's made by Tesla. When does that happen?
Yeah, I think you're spot on. This is probably one of the biggest question marks and potential challenges. To create that compelling business in robotaxi requires essentially two things. One is to solve the self-driving challenge, so create a vehicle and the technology that allows the car to drive safely and drive people around with no accidents, etc. Tesla is clearly behind on that. The key to succeed there is the ability to test thousands, millions of miles in full self-driving mode and autonomy. The choice that Tesla has made is to essentially build that capability using the cars that are sold and used by customers. But this has proven to be slower than the approach that other competitors like Waymo have used, which is a dedicated fleet, driving miles, accumulating the knowledge and the data that allows to enhance the system. And that's only one part of the equation. The other part of the equation is building a compelling business. You have to create a fleet of vehicles. You have to have enough of them correctly deployed so that when a customer needs a ride, the car is only a few minutes away, and you can do that in an affordable way without losing money on each ride. And that's an area where there's competition because Uber and Lyft have been doing that for decades. And you see with the partnership between Uber and Waymo, that has been very successful since a few weeks in Austin, since Waymo launched on the Uber app with Uber.
I am curious, Karim, like what's the safety like now, based on what we know of what's on the road or what's potentially in development? I mean, you mentioned Lyft. You actually worked at Lyft for a few years as well. And we know some of these ride-hailing companies really think that this is kind of the sweet spot for using these fully autonomous vehicles once they are approved. When we talk about all the components that go in there, and I know DVX is a big investor in a lot of the companies, not just the headline companies, but a lot of the companies that make the technology components that go into it. Are we at a point where we feel safe enough to be in there? I mean, from your view, you have no issue getting in one of those and zipping around town?
I'm personally totally in, and I think for the services that had enough time to test and fully test and validate, like Waymo has done and a few others, I think where we need to be in terms of safety and reliability of the service. Now, to your point about what's exciting these days is there's a lot of focus and highlights about the use of AI to solve autonomy and self-driving. What gets us really excited, especially at my firm DVX, is that we see AI being used today to solve problems of today with technology of today. In the automotive industry alone, there's a lot of problems that could use technology and AI. For example, inspecting a vehicle to make sure that the vehicle is safe to drive and doesn't have any issue to be repaired. We've invested in a company called Self-Inspection that solves that problem today and is able to replace humans and provide that reliability and safety that we didn't have before. So very excited about how the technology moves, and the key is to understand that it's not just about self-driving. There's applications of AI that work today to solve real problems in our society and in our world.
Karim, really appreciate your insights. This was a wonderful conversation. Karim Bousta is a co-founder of a company called DVX Ventures, which invests heavily in this space, and a former executive at Tesla, also a former executive at Lyft, GE, Symantec, and quite a few others. As we focus in on Tesla's earnings, and more importantly, just the broader ecosystem when it comes to AI, when it comes to autonomous driving, and more importantly, when it comes to the leadership in that space, we have to turn our attention to a letter that was just published today. It's an open letter by the treasurers of 8 U.S. states, written to the board of Tesla, questioning the direction of the company. I quote, Elon Musk continues to divide his attention across multiple companies and a high-profile advisory role within the federal government. These external commitments raise serious questions about whether Tesla's leadership is fully engaged in addressing the company's core challenges. Pleased to say Mike Shepard joins us right now. He's our senior editor of technology and strategic industries. He joins us from our Washington bureau. Mike, let's talk about the signatories on this letter. Several prominent people from several states here with investments, of course, in theory, in Tesla itself, making it clear here that they are concerned about its leadership.
Well, you're right, Romain. They are expressing a concern that has been growing among investors and among funds that hold Tesla stock for a number of months since Elon Musk joined the administration, since he made this political pivot toward Trump over the summer in July and began devoting more of his attention to the president's agenda and less to what these investors see as the company's needs. And that includes making sure that that lower cost Model Y is actually going to hit the roads when promised, that they are able to deliver on some of these other areas that they have been talking about for a while. And that includes the self-driving vehicle question as well, and robo-taxis. But without Musk really at the helm, the treasurers and other investors are saying it is not working, and they are expressing dissatisfaction over this. And of course, we saw, Dan Ives, whom we've all talked to on our own airwaves, the Wedbush analyst and Tesla bull, point out to a code red moment in his words that they're about to enter without Musk at the helm.
I am curious, though, how much of some of the issues that have plagued Tesla been about the fact that maybe he hasn't been present, or at least as present as he would have been, and how much of it is it also just about his politics, or at least the public airing of his politics, which, as you know, Mike, has rankled a lot of folks the wrong way?
Well, it really has. And we've taken a look at how that has been felt. And what we're seeing is that a YouGov poll last month just showed that 49% of those surveyed held a negative perception of Tesla and would not buy one of its vehicles. And a number of them, 37%, linked it directly to Elon Musk. And the perception about his politics is spreading to the dealerships and the cars. And the state treasurers in their letter noted that there were a number of trade-ins of Tesla vehicles. And this is notable because the buyers and drivers of Teslas over the years, as you and I both know, have been very loyal. They're brand loyal. They're believers in it. The cars are cool in their view and high performance in their view, and they really appreciate all those features. And to see this shift in sentiment and these trade-ins and people putting stickers on their car that's saying, I bought before Elon supported Trump, signals this. And we've also seen vandalism of these cars and even some attempts at arson at some dealerships. So there is very much palpably a sentiment going against the company that is connected to his political activity.
Mike Shepard, our man in Washington, D.C., of course, discussions right now about those treasurers signing off on an open letter here, raising questions here about the leadership of Tesla. Those signatories include the Washington State Treasurer, as well as treasurers from Massachusetts, Illinois, Connecticut, New Mexico, Colorado, Vermont, and California. And I'm pleased to say that the state controller in California joins us right now. Her name is Malia Cohen, and she is one of the signatories on this letter. And Malia, I mean, this is a pretty straightforward letter. You're asking the board for some clarity on executive compensation, how those decisions are made, some clarity on how they're going to communicate strategy, and more importantly, some clarity on how they're going to address the future leadership of this company. Have you received a response at all?
No, not yet. We haven't received a response, but Mike Shepard really, I think, framed it up perfectly. We just want to know that somebody is paying attention, that they are paying attention to the business, the health, the well-being, the growth potentiality of this business. I'm coming to this conversation as a fiduciary, as a long-term institutional investor, and I am concerned because Tesla new car sales are down 15% in the state of California. And that actually has a multiplier effect on our entire economy. If car sales are down, that means that's a loss of revenue for our state sales tax. We already have a growing deficit. And so we are coming to this very thoughtfully, as we would with any investment in our portfolio.
There's a sense, though, too, like particularly, Malia, when we look at the board of this company, there are a lot of people that are very closely aligned with Elon Musk, including his brother. People, and I don't want to speculate, but people that maybe aren't necessarily in a position to push back, maybe, as if they were truly independent directors. Is this something also that should be addressed, or is this just about the leadership at the top with the CEO?
Well, I think you're getting at a very good point. What you're describing is board governance. And that is something that certainly should be taken under serious consideration. And I would agree with you. I don't want to speculate either. But there are some very chummy and very close relationships with the board of directors of Tesla. Now, we weren't scrutinizing this board when times were good and everyone was making money off of Tesla. But now we have taken a turn for the worse. And now we are losing money. I'm on CalPERS and CalSTRS, the state of California's largest pension funds. I think arguably two of the largest pension funds in the world. So we've got about $800 billion of asset under management. Now, just in a short period of time, we have lost $1.6 billion. So what does that actually mean? That means that retired teachers, retired librarians, retired state employees are at risk of not getting their retirement checks. We can't allow that to happen. So what if we get if the plant if the asset continues to underperform, our plant continues to lose money? That means that the state government will have to compensate. We'll have to make up the difference. And again, that's going to be incredibly difficult in a state budget that's already, I don't know, we're looking at a deficit anywhere between $40 to $7 billion.
Well, that's what I'm curious. Well, that's what I'm curious about, too, because when you look at, on the Bloomberg terminal, you can see what CalPERS holds, and as well as the other pension plans, government pension plans in California, and it's sizable. And then, of course, I overlaid that with the losses that have occurred in the stock over the last few months, 50% just since December. And really, if you go back even further than that, the reductions have been pretty severe. And I do wonder if you're concerned at all that those losses might not actually be recouped, at least not anytime soon.
Yes, I'm concerned. I concerned. Every person that signed on to the letter is concerned. There are people who aren't even in the letter that are sitting on the sidelines that are also concerned. This is a very real concern because I stated earlier, this will impact retirees in a most negative way. And it's almost self-inflicted. So it's hard to excuse this position that the Tesla stock finds itself in. There needs to be someone mining the shops. Someone needs to be paying attention, coming up with creative strategies so that their business model is going to flourish and become positive in terms of cash flow for all of their investors. So yes, this letter clearly states, hey, listen, time out. We're very concerned. We want you to start paying attention. What are you going to do? How are you going to right size this ship? And no, the answer to your question is no, we have not gotten any answers yet. Tesla stock is up 5% today, so a little bit, a step in the right direction, but just not enough.
I don't want to get too into the investment process or the investment decision process, but we talk about a company that has returned a lot of money for investors over the years, a company that, at least up until recent years, was pretty much singularly identified with California, being its former home base and obviously a big production facility there here. Has there been any discussion here about divesting?
Well, that's an interesting question, too. Yes, there's always conversation about divestment. Now, that conversation is happening on the retiree level. Our plan members, they come to the meetings, they write letters, they send emails, and they have been calling for a divestment for several months now. Now, as a member of the body, on the trustee and on the investment committee, I can say that we are still invested in this asset and are not considering a divestment. But we are considering, we are saying, hey, there's a timeout. We need to reset and rethink this strategy.
And just one quick final question, Malia. I am curious as to why we didn't see more signatories. 8 out of 50 states, and if you include our territories, that's not a lot. Are there other folks out there, other states that aren't on this letter that were concerned, but maybe just didn't feel like going public with it?
I'm going to tell you from my own personal experience, I get asked to sign on to many letters, and I rarely do. But I felt absolutely compelled to sign on to this letter. And I think what you also will find is that you have a lot of the larger funds. So that are signing on, which is pretty significant. As I said, California coming on and signing on is nothing that you can just turn your nose up to.
No.
We are a $800 billion plan combined between CalPERS and CalSTRS.
Mm-hmm.
And you'll start to also see some of the larger plans across. Now, will we see more people coming on board to sign on the letter, or if there are future letters to come? I think you will. But I think what you have are maybe 8 of the courageous folks that are willing to say we need to be doing things differently.
All right. Well, obviously, at least in terms of economic power, California is certainly the biggest on that list. Malia, really appreciate you taking time for us, the state comptroller over in California. Malia Cohen. We'll be back in a moment. This is Bloomberg. All right, let's take a look at Boeing, scheduled to report earnings in just a few hours' time. The company also today agreeing to sell its flight navigation unit for almost $11 billion, the first major portfolio transaction under the relatively new CEO, Kelly Ortberg. And of course, the move coming ahead of those earnings tomorrow, which is expected, believe it or not, to show some degree of improvement after several losses. Sheila Kahyaoglu joins us right now, senior aerospace and defense equity research analyst at Jefferies. What should we expect out of those numbers tomorrow?
We're expecting positive results out of Boeing. We've gotten what we needed to out of the deliveries. They're trending really well for Boeing. We're not foreseeing any additional defense losses, and they're making progress on their portfolio transformation with the asset sale today for above 30 times EBITDA, which is a big number in this market.
Well, it's funny because when I saw that deal, my first thought was, why are they selling this? Then I saw what they got for it and more the premium that they got for it. Was that surprising?
It's undisclosed exactly how much EBITDA came with the asset, but we're estimating slightly above $300 million. So pretty big number in this volatile market, sold to private equity. There was a bunch of strategics involved, but it bodes well that there's several assets within the services portfolio that could generate additional contributions to their capital.
So what does that say to you about what Ortberg has done so far?
I think it's more slow and steady. We talked about how we recently visited one of Boeing's plants. It's 787 Charleston plant. And both Kelly Ortberg and Stephanie Pope, who run Boeing Commercial, have really made steady improvements into the workforce, the big strike. So what does the workforce today need? They need YouTube videos, they need video instructions, they need non-aerospace terms to get through manufacturing processes. And it's been slow and steady improvements on max rates. 87 has seen a bit of hiccups, though.
Okay, so the elephant in the room, though, is still going to be trade and tariff policy, and everybody wants to hear what Ortberg has to say about that. When you get your stories about that China is basically instructing folks not to take any more deliveries and maybe even trying to make contingency plans for getting parts, does that worry you when you're trying to analyze how this company is going to perform?
I think the results today concern me a little bit. You know, if you think about aerospace and defense, it's the largest U.S. manufacturing surplus that we have. But we saw results out of Lockheed, Northrop, GE, and Raytheon become pretty volatile today. And Hexcel as well, all on tariff and the impact of that on the profitability of these companies. There was some divergence in what to expect. But for Boeing, we don't actually think they're going to talk about a tariff impact because we still think this is a short-term play in terms of what the Trump administration puts in. And given the backlog stretch for so long, we think they'll mitigate a lot of it.
Is Boeing comparable to those names you mentioned? I know it's a big defense contractor, but obviously they have a huge commercial aviation business.
So when we think about Boeing Commercial, we think they have about enough airplanes in inventory to get them through 2025. So the tariffs wouldn't be a 25 impact, whereas Raytheon and GE are engine manufacturers buying that raw material today to deliver in 2025. So Boeing has the planes in a parking lot somewhere. They're putting finishing touches as they ship it out for 25.
In the short term, square the circle with what we might hear from Boeing and what we heard from the airlines over the last couple of weeks with regards to, I guess, a somewhat dour forecast in terms of travel trends.
I forgot about Boeing in China. Boeing in China, China's only about 5% of the skyline going forward. It used to be 25%. 5 years ago. So they've really mitigated China. In terms of the skyline, we just got off the phone with General Electric. They took their departure forecast down from mid-single digits to low single digits for 2025. Some of that is because of what we've seen out of the U.S. carriers, whether it's Delta, whether it's United. But they're not really seeing softness anywhere else in the world, and they're not even seeing it in the U.S., to be honest, even though we're seeing those capacity cuts. So for now, folks are still saying that demand is holding tight, but they're sort of putting that risk into their forecasts.
All right, Sheila, always a great conversation. Be sure to stick around tomorrow. A full coverage of those earnings out of Boeing by Team Surveillance in the morning. Sheila Kahyaoglu, Senior Aerospace and Defense Equity Research Analyst over at Jefferies. As we continue our coverage here on The Close, we do want to check in with Scarlett Fu. She's on assignment. In fact, she's doing a conference right now, Sell-Side Leaders Forum, right here at Bloomberg, and she's speaking right now with the CEO of Deutsche Bank US. Let's take a listen.
Some of them where we invest more and to build out these businesses faster and stronger. And these are in sort of say priority credit trading, rates, and the M&A side of corporate finance. These are the three areas where the bank, coming out of the transformation, which ran until end of 2022, since 23 is in growth mode and deploying a lot of investments against.
Even within M&A, is there a specific area within the verticals that are a good story right now that you're excited about?
So obviously, if you look at verticals, you always would like to do more, but you cannot afford everything.
All right, here's what markets will have their eye on over the next 24 hours. That includes earnings out of Boeing and earnings out of AT&T. Those crossed the wire prior to the open of the cash session tomorrow. Meanwhile, once the bell rings at the end of the day, we're going to get results out of IBM, Texas Instruments, ServiceNow, Lam Research, as well as Chipotle, a good cross-section of the U.S. economy. Economic data also on tap, including new home sales, which are expected to actually rise in the most recent month. We're going to get MBA mortgage applications, which are actually expected to fall and continue to contract. And we get that first reading on S&P Global Manufacturing and Services PMI for April. A lot of Fed speak tomorrow as well, out of Kugler, out of Goolsby, Muslim, Waller, and Hammock. And down in Washington, the IMF World Bank meetings continue with the IIF Global Outlook Forum. Please tune in tomorrow right here on The Close on Bloomberg.